can you give us your base case, not numbers specifically, but say in 6 months you think there could be a recession, and then S&P will have a drawdown of certain percentage. Is that sort of what
Yeah, yeah.
you're
Well, I
seeing?
think the way I'd actually think about this is um, the economy. What is going to happen is that there's going to be a significant supply of assets into the economy, right? Supply, sale of assets into the economy, and that's going to start to create and continued elevated, Fed tightening, right? And that's going to create a drag on all asset prices. And the question really is, how low do all asset prices have to go relative to where they are today to start to create a situation where you start to see some value in them? And that's where what I'd say is like, a balanced basket of assets, say like RPAR, the RPAR ETF, which is just the risk parity ETF, the all-weather style product that people can look at. I could easily see a circumstance where that falls 15% from where it is today, 15-20% from where it is today. I think the question is how exactly does that work out, right? That could happen through the fact that the bond market falls a lot and stocks fall a little less, meaning interest rates rise a lot and the stock market falls less as a function of that. We could also have a situation actually where interest rates go down, right? That probably wouldn't be the first step I'd expect, but interest rates can go down and stocks can go down even a lot more. And so that's really, I think, the more sort of confident bet right now. I know that I'm not answering your question, but somewhat on purpose, because one of the beautiful things about financial markets is you don't have to trade a particular asset if you don't want to in the particular form that it exists. You can pick whatever assets you want to trade, however you want to trade them, right? And so what I'm saying is like, no, I don't have a particularly, let's say over a 6-month time frame, 6 to 12 month time frame, I don't have a particularly strong view on stocks. I have a particularly strong view that assets need to go down in aggregate. I'm less confident about exactly what that mix is between stocks and bonds. And so being in a position to basically trade the package rather than the individual assets, I think makes a lot more sense. And that's where I'm talking about something like 15-ish% is probably where we need to go from here, given the current levels of valuation.
Okay, that makes sense. So when you say fixed income, does that mean that the price of it will go up and I guess the yields will go down, or are you sort of flipping it the other way?
Yeah, that's what I'm saying. In
Yeah.
it could be, if you just think about like a balanced portfolio of stocks and long duration bonds that are risk matched to stocks, so like a TLT SPY combination of assets, like that package of assets needs to go down 15%, 15 to 20%. And so the solution to that could be they both go down 20%. You could have stocks go down 40% and actually bonds be flat or up, right? You could have bonds go down a more meaningful amount and stocks only go down a little bit because, whatever, inflation's higher than people expect. And so it goes more into the bond market than it does into the stock market. And the stock market benefits from the higher inflation. Some combination that looks like that, I think, is where you want to be positioned. And so that's why I say, because of the uncertainty about exactly how it flows through, better to be positioned sort of short both those assets on the long end. Stocks are essentially a long duration asset as well as bonds, because you're probably that's got a better ratio trade. That's a better ratio trade than trying to pick which one you're talking about. And I think probably one way to think about this is if you look at sort of the term premium of bonds. Let's just think about that. Like, what's the world look like today? And the term premium of bonds, the reason why we look at that is that basically helps you understand the trade-off between holding cash and holding financial assets, because the risk-free long end risk-free rate exists in all financial assets because it discounts all cash flows. The term premium in bonds today, like, cash rates are in the fives and long end bonds are in the fours. And that's a pretty unattractive position to be holding long bonds relative to cash. And so what needs to happen in order for long bonds to look interesting relative to cash is you've got to have that term premium move up, say 75 basis points or 100 basis points, something like that, right? In order for you got to get 75 or 100 basis points more yield on assets relative to cash for assets to look attractive to hold relative to cash, right? If bond yields today were 5.25 or 5.5, you'd say that's not a bad bet right now, right? Not a bad asset to hold. Okay, well, what that means is if those have a 10 or 15-year duration and you move 100 basis points, you got to have a fall in price of 10, 15-ish%. And because the bond yield is really the discount rate for all assets, that discounting will exist in all assets. And so all assets will have to move down something like that 15%.
Yeah, it's really interesting. Thanks for explaining that, because I guess that's not a way that most people usually think about
I know
markets.
I'm sure I'm sure it's not how the everyday person that you talk to thinks about how these things work. But anyway, that's the bonds are in the stocks. That's a very important thing to always remember. Bonds are in the stocks.